If you're a military veteran, active duty, guard, or reserve, your income is not always just a simple paycheck. You might have a base pay and a BAH, drill pay, VA disability, retirement, rental income, border income, or even a mix of all the above. The good news is that the VA Lender's Handbook actually tells lenders how to use these income sources to help you qualify for a VA home loan. And in this video, I'm going to break down how VA underwriters look at active duty income and your LES, BAS, and other military allowances, guard and reserve income, recently discharged veterans and VA disability income, rental properties, multi-unit homes, and border income, alimony, child support, auto allowances, and other income, and how taxes and deductions are estimated in a VA loan analysis. And by the end, you'll know how to make your unique income work within the VA guidelines. Hi, I'm Alex Ramirez, and I help military veterans and military families use their VA home loan benefit to build long-term stability and wealth. And if you want simple VA content that respects your time, hit that like, subscribe, and tap that bell so you don't miss any of my videos in the future. I do weekly updates. All right, let's get started. So let's go over active duty income and your LES. So for active duty military borrowers, the key income document is your LES, your leave and earnings statement. The VA allows your LES to be used instead of a standard verification of employment. Your LES must be original, electronic, or a certified true copy. It must be recent, usually within 120 days of closing or 180 days if it's new construction. We're always going to typically ask for your most recent. Underwriters will use the LES to verify your base pay, years of service, ETS date, your expiration of term of service, allowances like BAH, BAS, clothing, and specialty pays, and ETS within 12 months. If your ETS or your end of a contract is within 12 months of closing, the VA requires extra documentation to prove that your income will continue. And here are some acceptable options to include. So documentation that you have already re-enlisted or extended past 12 months from the closing date, and a valid offer of civilian employment or verification of your future retirement income. A statement from you that you intend to re-enlist, plus a statement from your commanding officer confirming you are eligible and they expect the re-enlistment to be approved. Or unusually strong compensating factors like at least 10% down from your own funds and at least 6 months of full mortgage payments in reserves. Or a spouse's strong civilian income that carries most of the load. The idea here is really simple. If your current orders end soon, the underwriter needs to see what your income will be after that time. Base pay is considered stable unless you are within 12 months of your release date and you do not plan to re-enlist or extend. So let's go over BAH, BAS, and other military allowances. One of the most powerful parts of military income is your allowances, BAH and quarters allowance. Basic allowance for housing or BAH can absolutely be included in your effective income if it properly is verified. BAH is non-taxable, which helps your qualifying ratios. That'll be increased by 25% to help you qualify. The underwriter must verify how much BAH you will be receiving. This can change by duty station, pay grade, and dependency status. So they make sure that they are using the correct amount. But you still must meet the VA occupancy rule, so which generally mean you intend to live in the home as your primary residence. BAS and clothing allowances are also shown on your LES. These allowances can be included in your effective income if they are verifiable. And they are also non-taxable income, which is increased by 25% to help you qualify. Clothing allowance is often listed as an annual amount. For the loan analysis, the lender converts it to a monthly amount to help you qualify. And here are some other military allowances. There are other allowances like language or proficiency pay, parachute pay, scuba or dive pay, flight pay, hazard pay, overseas, sea, or combat pay. And to include these in your effective income, the underwriter must verify the type of amount of the allowance, how long you've been receiving it, and whether it's likely to continue based on your duties. These special pays are often subject to periodic review or testing, so they are not always guaranteed forever. And if it can be shown that the pay has continued for at least a long period of time and is expected to continue, it can be added to your base pay to help you qualify for the loan. If they cannot be sure it will continue, the income might still be used to offset some short-term debts for 6 to 24 months instead of being fully counted as your income. For tax purposes, some allowances may be taxable and some are not, so underwriters may consult IRS guidance in this case. So guard, reserve, and recently discharged veterans. Now let's look at the income for a guard and reserve service and from other veterans who were recently discharged or about to separate. Income from reserve or guard service can be used if you've served in the capacity long enough to show a good probability that it will continue for at least 12 months. The underwriter can look at your overall active duty and reserve history to make that judgment. If they are not comfortable using it as full effective income, this income can sometimes be used to offset short-term obligations between 6 to 24 months. And if you're currently activated, the lender must consider the impact of that activation. For example, if your normal civilian job pays $3,000 per month and your current active pay is $3,500 per month for 12 months, the underwriter must still qualify you based on the lower, more permanent civilian income, especially if the activation is temporary. Each case is evaluated individually. There is not a one-size-fits-all rule for loans. The goal is to give you your benefit without setting you up for financial hardship once your orders change. For recently discharged veterans or those about to separate, the underwriters look at your new employment income, any retirement income, and VA disability income if you receive it. VA disability is considered a benefit. It does not need a special analysis of future continuance once it's been awarded to the vet. Usually disability income is listed on your certificate of eligibility. Your COE works as a two-part document. If it is not, there are some specific situations where the VA verification of benefits form and award letters are needed to verify that information. So when you're very close to being discharged and your disability claim is not complete, the exact amount may not even be known yet. In that case, the underwriter cannot use a future estimate of the disability income. They have to work with income that is already awarded and being able to document it. Cases involving recently discharged veterans require more judgment because your civilian job history might be short. And if your new job is similar to what you did in the military, that is a positive sign for stability. Each case is fully developed and documented. If you're a guard, reserve, or recently discharged, and your income is a mix of civilian work, drill pay, and maybe expected disability, don't try to figure this out on your own. Reach out to me. My information is here. Give me a call or send me a text message, or you go to my description below and schedule a discovery call and we'll go over everything in detail. Let's go over rental income, multi-unit homes, and also boarder income, so a roommate that pays rent in your house. Now let me talk about one of the biggest wealth building tools with VA loans, rental income. Turning your current VA home into a rental property, if you're buying a new primary residence with bonus or second tier entitlement and you plan to rent out your current home, VA allows something called rental offset. And let me explain to you how it works. Your current VA home loan has a principal and interest, tax, and insurance of, let's say, $1,000 per month. If you rent it for $1,200 per month, that $1,200 can be used to offset the $1,000 mortgage payment as long as there's no sign the property will be hard to rent. And the extra $200 above the mortgage payment cannot be used as additional effective income, but it gives you a little bit more of a cushion when you buy your next home. Reserves are not required purely for the offset on the property you are moving out of, if you are just using the rent to cancel out the old mortgage payment. So a working knowledge of the local rental market is very important. If there is no signed lease yet, but the rental market is really strong, the underwriter can still use projected rent for offset with an explanation on the loan analysis. Let's go over some rental properties that you may already own. If you have a rental property and you want that income to count, VA wants to see documentation of cash reserves that's equal at least to 3 months of the principal and interest, tax, and insurance of each property. Signed tax returns or transcripts for the last 2 years showing the rental income. So the Schedule E they're going to want to see. If there is no loan on the property, you still need reserves to equal to at least 3 months of the property expenses like taxes, insurance, flood insurance, or any type of HOA fees. And you cannot use equity in the property as reserves. It has to be cash reserves in a retirement account, checking account, savings account. Gift funds and cash out from a VA refinance cannot be used to meet these rental reserve requirements. The money must be in your account before a new VA loan closes. And when analyzing rental income, depreciation can be added back to your income. And if there is still net rental loss after adding back the depreciation, that loss must be deducted from your overall income. If rental income is not being used at all, then you do not need to rental reserves, but the full mortgage payment is counted as a liability. And multi-unit properties with the VA loan. For a 2 to 4 unit property financed with a VA loan, you must occupy one of the units as your primary residence. To use prospective rental income from the other units in your effective income, the underwriter must verify cash reserves equal to at least 6 months of the principal and interest, tax, insurance of the entire property, experience managing rentals or a plan to use a property manager, and the amount of rental income typically counted is 75% of the lease amount for existing properties, or 75% of the appraiser's opinion of the market rent for proposed construction. Equity in the property cannot be used as reserves. Cash out from a VA refinance cannot be used to meet the reserve requirement either. It must be your own funds. And boarder income. If you rent out a room to a boarder or friend or family member in a single family residence, that income can sometimes be included. And here are some of the requirements. Tax returns for the last 2 years showing the boarder income. And the rental cannot change the residential character of the property. The rented space cannot be more than 25% of the total floor area. If the local market is strong and there is a reasonable chance you will keep a boarder, that income can be included as your effective income without extra reserve requirements. Let's go over some other income types and how taxes are estimated. Alimony, child support, and maintenance. If you receive these and you want them to be counted, they must be likely to continue for at least 3 years after closing. And underwriters look at whether the payments are based on a court order or a written agreement, and how long you've been receiving them, and also how regular the payments have been, and whether there are reliable ways to enforce the payments. And also remember, you don't have to disclose this income, but if you want it to help you qualify, it has to be documented. Your loan officer won't ask you, you'll have to tell them. Let's go over auto and also other similar allowances. So many employers pay your auto allowance to help cover job-related vehicle costs. Generally, it's appropriate to use that allowance to offset that auto expense. If the auto expense on your tax return is less than the allowance, the difference can be treated as income. And if the expense is more than the allowance, the net amount has to be deducted from your income or treated as a liability. And the same concept applies to similar allowances tied to job costs. Okay, so let's go over some other income types. VA allows many other income sources to be used when there is a history of receipt, and they are likely to continue at least 3 years. And this can include pensions and retirement, disability income, dividends and interest, royalties, notes receivable, income from trusts, and certain public assistance programs, and long-term workers' compensation. VA disability income is considered a benefit and does not need extra proof of continuance once awarded. So a COE award letter or a bank statement can verify the amount, typically going to be your COE. So income from caring for fostering children can be used in a special way. So instead of counting as income, the underwriter can adjust the family size of the residual income requirement, which can help. You can check out my residual income video for more detail about that. Temporary income like VA education benefits or most unemployment is not counted as effective income unless unemployment is a regular part of a seasonal employment pattern for your job or career. So taxes and other deductions. On the tax side, underwriters estimate federal income tax, Social Security, state and local taxes, and they use IRS and state guides based on your residence, not just what your pay stub currently shows. And if you have a mortgage credit certificate, MCC, from a state or local program, that can generate a tax credit based on your percentage of your mortgage interest. That credit could sometimes be converted into a monthly amount and added to your income for qualifying. Underwriters also consider things like childcare costs for kids under 12 years old, large commuting costs, other direct job-related expenses, and all this feeds into your residual income. It's the money you have left after all major expenses. In VA lending, residual income is one of the most important safety checks. Check out my VA residual income video. It's going to have all the detail there and you'll understand how residual income works exactly. And your income picture as a veteran can be complex, but the good news is that the VA gives us a framework to make it work. Whether you're active duty with multiple allowances, guard or reserve, recently separated, receiving disability, or building a rental portfolio, there is usually a way to present your income correctly. And if you want help applying these rules to your situation, reach out to me. My information is going to be right here on the screen. Call me or text me, or go to my description and schedule a discovery call with me, and we'll go over your situation. And remember, be smart, be prepared, and let's get you home.